Hello and welcome to part 2 in this two-part series of videos on pairs trading. In the first video we covered the general basics of pairs trading. Don't worry, we are going to recap that very quickly in just a moment. In this second video we're going to run through a more specific example. We're going to work through the actual numbers, so do watch through to the end of the video so that you get to see all that. Hello, I'm Peter Martin with Trading 212, and we add educational videos about trading to YouTube regularly. If you haven't already, subscribe to our YouTube channel so that you get to know whenever we add a new video. Well, let's not waste any time. Let's jump in to a recap of some of these key basic points about pairs trading. So to recap what we have covered so far in terms of pairs trading, we are looking for two historically correlated instruments, two instruments where their price tends to move together. So we can compare the values of their prices, divide one by the other, and come up with a ratio that we might expect them to hold in that a normal range that we've seen has historically tended to prevail, and then we can trade when that ratio moves out of that normal range. If that ratio is too high, then we're going to be selling this one and buying this one. And if that ratio is too low, then it's going to be the other way round. We'll be selling this one and buying this one. So we're buying the undervalued one and selling the overvalued one. And our strategy aims to be market neutral, meaning that we don't really care about the direction of the wider market or even the direction of our pair. They can go up or down. What we're really interested in is this ratio returning to what we consider to be this normal range. So if there are any points there that you want to hear more about, do check out the first video if you haven't already. Now, as we move on to our more specific example, one question we need to tackle is, what are we actually going to trade? How do we select our pairs? In other words, how do we find these shares that are correlated? Well, let's look at that. When it comes to identifying a pair of equities that we might potentially want to trade, we're looking for very similar companies. We want them to be making their money from the same primary areas, that they operate in the same areas of business, because this is going to mean that they're affected by the same economic factors. So these kind of things could be news stories out for that part of the economy, or regulation changes, or changes in cost for the raw materials that they use, or their labor costs in that part of the economy. Whatever those changes are, the more similar our two companies are, the more likely that those changes are going to affect both companies in the same way. When it comes to finding companies that operate in the same areas, we're helped by the economy conveniently being divided up already into sectors and industries. If you want to learn more about sectors and industries, I have done a video on the subject, so check that out if you want to learn more. But if we look within an industry, we will find companies that are affected by the same economic factors, potentially. So it's a good place to start. So let's look at this in a bit more detail. Obviously, these are just a few industries and only a few of the companies in those industries, but it's just to give you an idea. Now, you're going to have to do some digging yourself and apply some common sense as to the suitability of these companies. For example, if we look at the banking industry here, these are complex global companies. So they have operations all around the world, and they may be subject to a variety of different regulations over the different areas in which they operate. Furthermore, if we look at something like Standard Chartered, it doesn't do any retail banking in the UK. Huge part of its profits come from outside of Europe. In contrast, if we look at something like RBS, it does do banking in the UK under a number of different names, NatWest, RBS, and Coutts, for example. So they're not as similar as they might at first appear. Similarly, if we look at the media industry here, yes, ITV, Auto Trader, and Rightmove might all make money in different ways from advertising revenue, But there are differences there. Pearson is involved in publishing, so although they're all media companies, they do differ. So this final industry is home builders, and the two companies I'm actually going to look at for my example are Barratt Developments and Berkeley Group Holdings. And these are both UK-based home builders, so pretty similar. So these are the two that we're going to take a look at. We can give our potential pair a quick eyeball test by looking at their price charts. Here we have a daily chart of the Berkeley Group at the top of the screen, and beneath it a daily chart of Barratt Developments. Now the charts aren't identical, but they are very similar. And really that's what we want. In general, the correlation between the two tends to hold, but there are occasional times when there are slight divergences in their share price performance. And these are our opportunities. For this example of using Barratt Developments and Berkeley Group, I looked at share price data for them both going back 1 year. Now there's nothing special about that time value. I just chose it because it was a fairly long time and readily available. Obviously, the further you go back, the more comprehensive your historical perspective on the price relationship is going to be. So this is just some of the early data in my data set. This table would continue on a lot further, all the way into the summer of 2019. Now, I made these price values, arrived at them as a kind of average using open, high, low, and close data. But you could use whatever you felt was representative, just opening or closing price data. Some kind of snapshot will still do a similar job. Now, ratio 1 here is the value of BKG divided by Barratt Developments. And ratio 2 is just the other way around, Barratt Developments divided by Berkeley. I found that this first ratio was a bit more useful. It told me a bit more just because, I ended up rounding to 2 decimal places, and that smoothed this ratio 2 out a bit too much. I found that ratio 2 spent a lot of its time hanging around, this is very roughly speaking, between about 6.5 and 7.5. So this is sort of my range that I felt was a kind of normal range. And once it started getting outside that range, that's when I thought it might be of interest in terms of trying to trade this equity pair. Certainly once we got up into the high 7s, it was of particular interest, and that is what I'm going to continue with in my example. Now, I found in the middle of December 2018, around about the 12th, 13th of December, that the ratio got all the way up to about 7.90, so higher than we would expect. And let's remember that our ratio was Berkeley Group divided by Barratt Developments, so that's higher than we would expect given the historical price relationship in our data set, and therefore we'd be selling BKG and buying Barratt Developments because we expect this ratio to drop. So the question is then, how much do we deal of each of those? So let's work through that next. Well, when it comes to choosing our position size, one thing we want to aim for is to try and get our exposure as equal as we can between the two companies that make up our pairs trade, because this is going to aid us in that aim of keeping the strategy as market neutral as we can. So let's work through the numbers for this. So to tackle this question of position sizing, let's actually look at an example of the opening. So on the 14th of December 2018, let's say these are the prices you deal at. 4.48 pence per share for Barratt and 34.90 pence per share for Berkeley Group. These were near the highs of the day, and let's say that you're happy to buy 1,000 shares in Barratt Developments. So your position size on Barratt is going to be £4.48 per share multiplied by 1,000 shares, which is £4,480. We want to get as close to this as we can with the Berkeley Group trade, because that's what's going to allow us to aim at that market neutrality that we want. So the actual ratio of prices that we're dealing at is 34.90 divided by 4.48. It's a ratio of 7.79. And all we need to do is divide those 1,000 shares by that number. And that gives us 128 shares rounded to the nearest share. And so that's what we would do as our sale. We would sell 128 shares of Berkeley at 34.90, and that would have a transaction value of £4,467.20. So we can see that's very close to the transaction value for Barrett Developments. And now a look at the closing of our strategy, the trades involved for our pair of equities. By the 25th of February 2019, so a good few weeks on from when you opened, the prices had moved to these levels. These are near the high of the day. And trades we would do would be the opposite way around to the way that we traded at the open. So you'll be selling 1,000 shares of Barrett Developments at £5.73 a share. That is a sale value of £5,730. And then we're buying 128 shares of Berkeley Group at £38.30 per share. That is a buying cost of £4,902.40. So our profit on Barrett is that sale value that we just had minus the opening cost, which gives you a profit of £1,250. And then your loss on Berkeley Group is that buying cost you just paid minus the sale value at the open when you went short, which gives you this loss of £435.20. So our overall profit would be this profit minus this loss, which gives you a profit of £814.80. Of course, this is ignoring all costs involved. So that was just an example using real numbers to give you an idea of how a pairs trade might work. One of the key risks that we mentioned in the first video is that the correlation between the two companies might break down. And the reason we look within the same industry to find companies that are so similar is that then the fundamentals have a good chance of backing up that correlation. But you do need to remain vigilant that nothing fundamental has changed to break down that relationship between the two companies. As always, don't proceed with a strategy until you are satisfied that it works for you. So it's worthwhile trying things out in practice mode first. If you're happy, if you're confident about the strategy, then perhaps it's something that might work for you. Well, I hope you enjoyed this video looking at pairs trading. If you did, please hit the thumbs up button and give us a like. And why not share your thoughts with us in the comments section? We do read each one. But that's all for now from me, Peter Martin, and Trading 212. Thanks for watching. Goodbye.